Weekly stock market update, friends. Are you ready? There is a heck of a lot of stuff. You're going to need a pen and paper and probably hitting the pause button because I'm going to give you so much materials going forward on this. I think I explained these pictures in the past, so I won't go through it again. So let's get on deep dive into the update. Don't forget to check out the campaign for 1 million. Either remember, by the way, I've been traveling to work on my book, Forecasting Share Prices, to be published by the Financial Times. This is not advice. This is not solicitation for you to buy or sell on any instrument. It is education information. Where are we on valuations? Well, of course, whilst these are expensive, you're paying $27 for every expected dollar of profit in Microsoft, and these are cheap. You will know full well that valuation is not the only thing that moves stock prices. If it was, then it'd be really simple. We would sell all the ones in red and buy the ones in green, and that wouldn't actually result in good performance, would it? Growth and these other factors are important, which is why you never, ever trust an IFA who says to you, oh, we've got a value fund, we've got a growth fund, because adding a rubbish fund with another rubbish fund doesn't give you a good fund. Two negatives actually don't make a plus. You need a fund which will select undervalued companies which are also growing and the other factors which lead to stock prices moving up. And valuation, as this proves, is only one of those factors, which is why IFAs and fund managers get it so wrong and your performance suffers so much. And if you think I'm the first one to discover that, you're sadly wrong. Eugene Fama got a Nobel Prize in economics for pointing that out. S&P 500, any of these earnings which are going to give markets a scare potentially? No, I guess you could argue Morgan Stanley on Wednesday the 16th before market opens, or roughly around now actually. I don't think any of these are going to be market moving. You could argue potentially with Blackstone. No, not big enough. Okay, but you might want to keep an eye on all of these anyway in case you own any of these stocks. Tesla, I guess, is the only one which on Wednesday next week after market close gives its results, and that could be a market mover. But beyond that, nothing else. They'll be stock specific. Okay, by the way, don't forget to do all of these things, please, if you wouldn't mind. So as I mentioned, we don't just look at valuation. We look at valuation together and we create an algorithmic score, which is incredibly important. Many try to reverse engineer. They don't come close. Value, growth, and income. Okay. Goes into that income meaning dividend deals. We also look at other factors such as cash return on capital invested. That comes from Goldman Sachs Wealth Management. If you're in the top quartile, i.e. your company is green, then you're likely to get 30% per annum, according to their research. I trust their research. Value growth income comes from Nobel Prize winning economists on why we should look at those factors. And then I scored it out of 10 so we can go through 10,000 companies. We need all 5 of these columns to be green. Sortino and Alpha comes from the hedge fund industry, as does Momentum, which is that. All of them need to be green for the stocks. So let's look at some of those and see how they do for us. By the way, I'm actually helped tremendously by this. The frequency of rolling 2-year S&P 500 returns since 1950. The average positive return is 32%. Imagine over 2 years, your pension went up by a third. You'd be happy, so would I. Positive returns happen 88.5% of the time. So they might make me look like a genius, but I'm not. I'm just in the right place. Just as when people say, oh, I like to be in rising sectors. Well, I like to be in rising markets. A third increase in my pension over 2 years, I am more than happy to take. In fact, part of my job is to make sure I don't trade my investments, i.e. I don't get in the way of that, and is to make sure that once in 7 years when the negative returns are bad, we've got out because we've looked at the momentum and the average prices, and if they're both declining short and long term, then we exit, as happened in 2022 famously, and I called it in January of 2022 and said we're holding cash, okay, for that year. Now, that makes me look cleverer than I am. It helps my results tremendously. Why is it then that we keep seeing headlines like this? Has your pension lost a fifth of its value this year? That was in 2022. Why did that happen? Liz Truss. People thought bonds in a pension are safe. They're not safe. One size fits all pensions, as the Daily Mail pointed out, one size fits all pensions is the problem. Workers actively choose funds that are put into one size fits all. You need it to be bespoke. Don't take my word for it. Daily Mail journalist financial website of the year. Okay, that's the problem. The 8 biggest of these default pension funds have lost value this year. That was that year. If they can't help you, what the hell point are these professional fund managers? You really need to get your act in order and look into it yourself, let alone this. Also 2022, pension provider Mercer has been criticized for awful treatment of pensioners who are having a tough time accessing their pension savings. And that means if you're Morrison's, Marks and Spencer's, Whitbread or Scottish Power, they keep getting away with it. You really need to wake up and smell the coffee. Give workers the power to ditch pension schemes. No wonder the Financial Times says that. That's 2023, October the 20th, 2023. They said that. Pensions, why do those retiring face massive losses despite FTSE highs? Well, yeah, that's Aviva. People aren't looking at what the hell's going on with their pensions. Don't take my word for it. Daily Mail, The Guardian, right wing, left wing, all wings are saying this is what the hell is happening. Okay, over the past week, how's the market done? Lots of green. Fantastic. I was out in New York to speak to my Great Investments Program clients who are out in New York, and that was great. I'll put the videos up shortly. I've got a bunch of Americans, Canadians, South Africans, Brits, obviously Australians, as part of the program, as well as people in the Middle East and so on. So delighted to go around the world to meet them. This is where we are over the past week. Lots and lots of green. That makes life easier over the past year. This is what I really care about. Are you in a position when the markets are going up like this, which, to be honest, they'll be as buoyant as this. Out of every 7 years, 3 years, they'll be as buoyant as this. 1 to 2 years, they might be flat to down, and the rest of the time, they'll be sort of mediocre, okay? So are you in a position to take advantage of this? Because in those years when they bump up, you need your pension to have bumped up. If you're not even in a position, don't even know how to take advantage of these kind of opportunities. I didn't invent these companies. I don't make the markets go up, okay? I just put myself in a position to get lucky. And lucky means having some of these, if not all of these. So keep watching and I'll explain how you do it. So over the past year, amazing, amazing returns and results. Look at these. Look at these. Isn't that phenomenal? All right. So how are we going to capture it? Well, ETFs I'll talk about separately. These are funds, which are basically index tracking funds. They track a basket of stocks, but we'll talk about this in a separate video. So do like and follow. More interestingly, markets year to date, the S&P up 22%. Is your pension up 22%? Now, it depends when you started. This really is since January. Of course, if you started around February time, you might have had next to 0% for most of the year because that's how it was. Okay, so don't panic. This is why we look at 12-month holdings. We don't judge it over 6 months or over 1 month or over 3 or over 4. We don't say, well, after 4 months I've done this, so pro rata I should do it. It's not physics, it's not mathematics. And this shows you, most people don't realize that you can have gains and then lose them all time and again, okay, and yet still get your 22%. How? By not fiddling with your investments. Don't trade your investments. Right? But you've got to make sure the investments are right, which is why I keep coming back to this. Don't keep trading out. Otherwise, what will happen is the first time the market sneezes, you exit, and then you miss the biggest gains. That becomes the problem. By the way, as part of, you don't have to be a man to be in the Great Investments Program, although 80% are, but we've got 20% who will win. We do have our dining club, as it were, and I will send out more invites. They're complimentary, the invitations. That was a recent dinner we had at Lincoln's Inn, my inn, the Honourable Society of Lincoln's Inn, which I qualified as a barrister. It was a very nice evening. It just so happened they were all men, but more than welcome to have women on the Great Investments Program attend, but there'll be more of that in the future. I was out in New York. This is from my previous visit. I didn't get a chance to do Bloomberg this time, but that's from a previous visit. I used to be a presenter on there, so hence that. Now, let's look at these sectors. Now, all the sectors are up, but we don't take a bet on sectors. For those who think, oh, you must guess which sectors. And by the way, utilities, communications, financials, industrials, energy, not tech. I haven't mentioned tech. What we do is we look at the underlying company and don't care what sector it's in. As long as the company is healthy, of course it'll do better if the sector does well, but we're not. Imagine those were horses and you were gambling on which horse. We don't do that. So I just wanted to share that with you. Everything's gone up this year. However, which factors? Guess what? They're the factors that we look at: momentum, value, growth. Why? Well, because if you pick a stock which ticks all three of those boxes, i.e. a company which is a subset of a subset, so it's value, growth, income, you're more likely to pick a company which is going to go up than if you just bet on value only or growth only or income. And having just funds in any of those other factors would mean you're ignoring a lot of information, and that's why your pension's underperforming. Why don't fund managers do that? Well, as a marketing exercise, they prefer selling you 3 products, not one which works, sadly. Over the past year, you're up 35% on your pension. And if you aren't, you should have joined the Great Investments Program a year ago. It's not me who does it, it's the market. Now, of course, there were prolonged periods of 0% returns, which is one of the main problems I have to teach my students is wait. If the company you have is good, you will get 0% returns. You will get returns which have whittled away. Do not panic. It's whole psychology, teaching them not to panic when they've got a good investment. Just as Warren Buffett says, don't trade your investments. Don't keep panicking, okay? And you have prolonged periods of 0% returns, and that still gets your pension up 34%. If your pension is not, go speak to your wealth manager, go speak to your IFA. If it isn't up 34% in the past year, drop me an email. Okay, by the way, these are the FTSE 350 over the past month. That's how they've done. All right, China coming back in, but we'll look at some of this stuff in a moment. One of the reasons that I, in my SIP and ISA, don't just invest in UK stocks, but I have US ones, and to my US clients, yes, your country stocks, is this. Now, don't talk to me about currency risk when you're talking about a tenfold difference between the UK, which is this, okay, that's the FTSE, okay, and the US markets, NASDAQ and the S&P. You're talking about tenfold increase over those 15 years just by tracking an index. So they don't say to me, oh, what about the currency risk? No, it's fine. It's compensated for, okay? Because I want my pension to have done 600%, not 47%. The reason, very simple. If you only manage 5% returns, it'll take 14 years to double your money in your pension. If you get what the S&P 500 has done in sterling terms over the last 10 years, which is 15% per annum, you'll double your money in 5 years. Let alone if you can improve upon that, even better. Compounds even better, great. But we don't assume great positive returns. We don't assume that. We just say if the opportunity arises, we need to be in a position to capitalize upon it. That is my job. Okay, so where is the S&P in this market update? We are here. Got it? We are here. Would I buy into an S&P index tracker? Well, I've got it since January of last year. Okay, whoops, last year being 2023. So we've had it since January of last year, as you know, if you follow my YouTube and all the rest of it. Therefore, we've got a bit of an endowment of gain, so I'm happy to continue holding it. But would I buy more today? Well, it's a bit overbought, so I'd only buy it if I was risk-loving and thinking, you know what, I need to be in here. I've got FOMO. I know there's a risk of a down move, but I want to be in. At the moment, this is still rising, the momentum on the monthly, and therefore it's a benign background against which to buy stocks. Right, same with the NASDAQ, similar kind of story. Would you buy it if it was there? I'm happy to keep holding on. Why didn't we panic there? Well, because it's what we call a baby bear. And the people who panicked in August of this year, and I suppose it was July into August, sold out and don't realize the simple statistics that after the worst drops come the biggest gains. So they panicked, got out at the bottom, and they're now left wondering when they should get back in. Whereas those who were on my program had no reason to, because they knew it was a baby bear, because I've taught them baby bears are where the MACD is rising and you can ignore them. I should get a Nobel Prize in economics for that, by the way. FTSE 100 index, a way to go. It's sort of here. It's not touched there. So I think it's going to have sideways moves at least until another month. Don't forget, we've also launched as part of the Great Investments Program, the hedge fund 40% return stocks. These are stocks which hedge funds that generate 40% per annum for the last 3 years. So 3 years of 40% per annum, not just one hit wonder years. What's in their portfolios we look at, and then we say, do they meet our criteria? So it's not just saying the hedge fund owns it, let's buy it, because it might have held it since 1962. Do they now also meet our filtered criteria as well? And as well as that, is there a reasonable projection for the next 12 months on the existing trend of that stock for it to generate 40% for us. So quite a lot of, so don't forget, we've launched that as part of the Great Investments Program. So it might be hedge funds like this, which have generated 53% per annum over the last 3 years, potentially even longer. And we look at their holdings and then we say, do they meet our criteria, most importantly? We don't just look at their holdings. This is the bit where people stop listening. Oh, you look at their holdings. What if their holdings are out of date? No, they're not out of date. We're looking at their holdings and then we see, do they meet our criteria and can we get the 40% as well? So we whittle down their holdings into far fewer. Anyway, top 10 stocks over the past month. They're these. So let's have a look at these. Make sure we've not missed anything for our own portfolio, and then we'll look at the broader stocks as well. Well, Vistra meets our criteria there of 7, but it can't be a special situation because it's overbought. It can be non-special in that I would say if you think this is still likely to the upside, where would you put the stop loss? You'd put it here if you were a bit risk-loving. Safer place to put the stop loss is there. And you've got 2 times upside to 1 times downside. It's high risk, though, because it's overbought, just so you know, okay? Constellation wouldn't be part of our program. If you're trending forward and you really wanted to know an investment, well, you'd put the stop loss there because it's less than 2 times the reward. But we wouldn't have it as part of our program because we don't have it as a 7, 8, 9 or 10. So you can see how stringent we are. And the reward is greater than 1 times the risk. So that's good. 7, fine, overbought. So it'd have to be outside the program. That's pretty optimistic. If you think it can hit that, good luck to you. Where would you put the stop loss? If you're risk loving there, but it might get hit by noise, so you might want it a bit further out, maybe there. Down here seems a bit pointless because then you don't have a 2-to-1 reward to risk ratio. Okay, Las Vegas Sands. Yeah, I'd want that to break through. I want the blue line to break through the yellow to be a bit more confident of the moves being in this direction. And then I'd be happy to put a stop loss maybe safely at 43. Give ample room for that to move upwards. The reason being, if it's going to do this, it has no business going below there, does it? So then you know you're wrong and you've got your stop loss protected and you've got your downside. And it's 12 months, it's an investment. Don't trade the investment. Win Resorts, similarly, I'd want to see a bit more breakthrough there. So it's a bit too early to be in this. That's the projection. And in due course, similarly, the stop would be there. Norwegian Cruise, overbought, obviously, because of that. So how would you do this structure if you really wanted to? Because it is a 7, 8, or 9. Well, it wouldn't fall in the program because it's overbought on the MACD. But there's your projection to the upside. There's your stop loss there. Make sure that this is half of that, which it looks like it is. So you're fine in the reward to risk ratio. Carnival, again, outside the program because it doesn't hit the numbers. So 150 there, and there's your stop loss there, and you've got your reward to risk. This is good on the momentum. Sadly, it's not a 7, 8, or 9, so it can't be in the program. But if you were doing non-special or outside the program, you'd probably put the stop loss there, and you'd look for a projection there. You might say, no, thank you very much, Alpesh. I don't like the drawdowns. I don't like these drawdowns. Okay, remember, drawdown depth and duration determines your risk appetite. If you don't like the drawdown depths or durations, how long they go on, then stay clear. Similarly with this, outside the program, because it's not 7, 8, well, it's 7, 8, or 9, but it's overbought, so you put the stop loss there. How about with this one? 7, 8, or 9. However, stop loss would have to go here because it's overbought. Okay, so it'd have to be outside the program. Costco, again, outside the program because it's overbought and not 7, 8, or 9, but you'd put the stop there. Apple, well, if you're on the program, you'll know my views on Apple. I gave you yesterday, and Amazon and Microsoft, the update that I've given you, and I've got to make a note to take action on that. But for those on the program, you'll have seen it. Look at the private channel. Same with Meta, please. You can ignore this for a moment. So where are we on the top 10 S&P 500 stocks? Okay, in the past month. There they are. Let's have a look at those. Okay, just to see how we're doing. And you can see that basically you can see what I've said previously on these, where to put the stop, how to do it, and where to look at it so you don't mess it up. Okay, I've mentioned the hedge fund managers stuff, as you've seen. Bank of America, where are we? That's the projection. Still got some upside, so we continue holding. I won't buy more because it doesn't meet the criteria. Netflix, well, if you wanted to do it outside the program, you'd put your stop there. There's your projection. It's not 7, 8, or 9, so it's high risk. It's overbought. But, well, that's everything to say about it. Whilst it's overbought, so it'd have to be outside the program. Maybe you'd put the stop loss there. Maybe you'd put it here. But, yeah, you want 2-for-1 reward to risk. But there'll come a time when we get back into Walmart when it sort of shows this kind of position and it's a 7, 8, or 9, and we'll make double our money again. Berkshire Hathaway, you'd continue holding, wouldn't you? Maybe put the stop there if you wanted to get in outside of the program because it's not 7, 8, or 9 and it's overbought. Same with Eli Lilly. By now you know what to do. Okay, overbought. But there'll come a time when we're going to make our money in Eli Lilly again, and we'll triple our money on it again. This is a problem I want to highlight right now. This came in about a year ago. Been following you twice weekly stock market. I've been blown away with the information about it recently. I've been able to check my own pension provided by Legal & General. This was provided by my employer. Please check your pension. The information was shocking. 20% growth between 2012 and 2022. As you can imagine, and I take steps to remove as well. I've been following your weekly reports and I've invested very limited funds, but I've seen returns of around 20% this year. Okay, that's what I want. For people who think I look into the future, I don't. I basically do what Jim Simons, the greatest fund manager in history, has done. I have no opinion on any stocks. The computer has its opinions and we slavishly follow them. That's my approach as well. I didn't know he said that until he passed away. But that's his view. He generates 39% per annum after fees. That's my view. So is 39 or 40% realistic? Well, only if I think you've got a market tailwind, example 2021, 2023. I think if you've got high Sortino, high average return stocks, which generally outperform the market high alpha stocks. If you're not looking at, say, UK and emerging markets, but US, because you need to have a large number of high growth stocks, and US has them. If you can go to cash in a bad year like 2022, if you monitor once a fortnight, so you might need to exit anything that drops 25% from entry. If the good years make up for any bad years, if Croaky stocks, cash return on capital invested, the Goldman Sachs rule, which gets you 30% per annum, are included, you're holding for 12 months, then you reevaluate and you sell anything which drops 25% from the entry. If those rules are done, then this is what happened for us last year. Now, assume last year's results will never happen again. Assume there are no guarantee for the future, which they're not. It was not a typical year. There are no such things as typical years. Okay? For instance, the year before, we were in cash, right? And it does not mean any will be held in 2024. So what happened? Well, we got that return. Now, that's not going to happen ever again, because if it did, I'd be the richest man in the world if that kept on being generated. We had a bunch of picks based upon our value growth income rating. By the end of the year, this is how they'd perform. So how come there's such a wide disparity between -1 and plus 238? Because the same process leads to different performances because the stock market is not physics. And that's why you don't just have one stock. Well, wait a minute, Alpesh, why are there so many? You said they need to be all green. Yeah, because by the end of the year, on the exit rules, unless they've hit the exit rules, we'd still be holding them, and you'd expect them to be overvalued companies, and therefore you'd expect lots of non-greens, okay? And look at the same rules, we got a -1%, that's why we don't pick one stock. Imagine we missed NVIDIA and only had Tapestry, okay? So where are we? Well, some of these companies, I'll tell you to what extent I look at the computer and the data and all the work's done for my students, because I give them the data. The extent to which we look at it is this. I didn't know what MedPace does or Sterling Infrastructure does, okay? How easy it is to do all this? Well, it's so easy. You might open a Barclays or a Hargreaves Lansdown or AJ Bell SIP. You go online, you open it, okay? That's it. And then you say, I want to buy Microsoft. Here's £1,000. I'll buy Microsoft. You wire the money to the broker. There's lots of brokers. Here's an example with these. Do check their latest rates. This isn't bang up to date. And also, some of these cap their costs, so they're actually cheaper than exchange rate plus 1.5% because actually they cap it. So Free Trade, who did this table, are sort of not lying, but they're not telling the whole truth, so be careful. But these are popular brokers you could always go to. Remember, I'm on LinkedIn as a top voice alongside Mr. Bill Gates. Check out my campaign for 1 million to teach 1 million people how to be better investors. And the reason for that is because a lot of you come to me with your pensions stinking. Now, I set up a hedge fund in 2004. I lectured on behavioral finance at Corpus Christi College, Oxford, to show people the mistakes. I've written 18 books on investing. You can download a free copy from campaignforamillion.com of one of them. And at Bloomberg TV, I presented explaining these problems to people, and in my Financial Times column, of which there are 200 columns written, explaining all of these problems. And I used to repeat the findings of the three economists, Thaler, Daniel Kahneman, and Eugene Fama. They all went on to win the Nobel Prize in economics. So that's the foundations of what I do. My job in the Great Investments Program is to give you the data and give you the education. For those who are not on the program, I continue and I pledge to continue giving these free market updates to you so you do not miss out. Okay? But of course, being on the program is better than not, but I appreciate not everybody can be. Thank you very much. Because we've added also things like the intermediate tactical investments, those are the shorter term ones, and the hedge fund ones, and so on, the price of the program will go up. But I will continue doing the free stuff, so don't, so I just want you to know. Thank you all very much indeed.